Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, good day everyone. It's Liam Garman here, Managing Editor of Real Estate at Momentum Media, the team that brings you this Smart Property Investment Show. And today I'm going to be unpacking all things commercial real estate with the one, the only, the indefatigable Steve Bennett. Steve, welcome to the podcast.
Thanks, Liam. That's probably the best introduction I've ever had on one of these things. So
pleasure
to be here.
I'll add, next time we do this, I'll add a few more adjectives and then I'll plump up those feathers a little bit more. But look, before this podcast, I was doing a little bit of research on Charter Hall, and you develop, you manage spaces, you rent office spaces out. Talk to me about your side of the business. I understand you're the CEO of the direct property business within the company.
Sure. Look, the premise is very simple. Charter Hall is the largest manager of real estate in all of Australia, something that isn't very well known. And the business that I look after is simply making the highest quality property investments that are usually only available to large institutions, super funds, but making them available to our high net wealth, our family office, and our retail clients.
So you manage commercial office spaces primarily. What are some of the key trends that you're seeing at the moment in this market?
That's a good question. We're now 2 years into the down cycle. So it has been a tough period. The peak of the markets in commercial, and I use the term commercial to cover office, industrial and logistic, retail, basically everything that isn't your residential side of the market. So the key trend we're seeing is that we're approaching the bottom of the valuation cycle. We know investors have had a bit of a tough run in the last 2 years. We invest alongside our investors, but we're more confident than ever that some of the sectors have already bottomed at June and others are very close. In terms of sector-specific trends, well, there's the bifurcation of office. Simply means the top tenants want to be in the top buildings. So think close to transport, amenity, infrastructure, your clients. Secondary office assets we think will struggle over the medium to long term. In the industrial and logistics space, e-commerce, look, I could talk for a whole podcast on that. But if you just look at the basic facts, the penetration rate in Australia is around 13%. At the other end, you've got Korea at 30% and a global average of 19%. So we still see lots of runway and lots of demand for growth in the Australian industrial and logistics market. The retail space, an interesting one. All parts of the commercial market are not the same. So we split the commercial, residential and retail into the sub-markets. So when I'm talking retail, we tend to focus on the convenience retail. So your Coles, your Woolworths and a couple of specialties hanging off it, not the bigger malls which have a higher percentage of discretionary tenants. And we've already seen the bottom of the valuation trend in that space. So I'm glad to be here. I think if you had me on 12 months ago, the view would be a lot more defensive, trying to manage through the cycle, whereas now we're trying to position for growth and give our investors opportunity to benefit by coming in at the bottom of the cycle.
So it looks like there's some pretty positive statistics coming out. This is the time that you would suggest people enter into this. And like you said, you're opening the door for new people to come in, not just large corporations, but individuals, high net worth individuals to invest in this space. Why is it that we're seeing more interest in this area? Is it that you've got more people coming back into CBDs because we're seeing perhaps a reversion from hybrid remote working? Why is it?
Look, I would say some of the retail and high net wealth interest hasn't yet rebounded to the extent of some of the bigger institutions we talk to. I look after around $10 billion, myself and the wider Charter Hall team in the high net wealth space. What we are seeing is higher returns for the level of risk than you've been able to achieve in a long time. So the office market, for example, and I should say this isn't financial advice, so I'm not going to go into the detail, but we've pulled together an office partnership. We haven't done one like this for about 8 years, and we're doing it because we think you're getting outsized returns for the level of risk you're taking. So that's the benefit of coming in at a period 2 years into a down cycle. But not all real estate is the same. So if you think all office assets are going to give you the same level of returns, regardless of the quality, tenant profile, lease term, then unfortunately you could be in for a little bit of a shock.
Now, the skeptics among us would say that market conditions at the moment aren't looking too positive. I mean, you could go on the front page of the AFR and you see a lot of doom and gloom at the moment. Just why is this commercial sector working out so well, despite what people might be thinking?
Look, I'd say the last 2 years haven't worked out well in terms of valuation. So you've seen just assets in the office market come off 25% in valuations. Industrial and logistics, sort of a half to a third of that. Retail, depending on the sector, even less in terms of neighbourhood. So I wouldn't say we're in boom times. So I want to stress that to the audience. What I am saying is that some of the headwinds and risks, which if I was here 12 months ago, no longer exist. So if you look at valuations, after 2 years of devaluations, whether we're at the bottom or whether we're not, only time will tell. But what we do know is for those sectors that aren't yet at the bottom, we're getting very close. Interest rates, huge headwind for commercial real estate in the last couple of years. Again, varied views, but even if rates go up again, which is not the majority view, it's going to be at the margin, with most commentators expecting rates will now fall in the short to medium term. That'll be a positive. We haven't seen many tenant defaults. Surprised a lot of economists. And you haven't seen as huge an uptick in unemployment as what you'd typically expect and what you would have expected in the fastest level of interest rate increases in over 50 years. So from those point of views, the fundamentals are looking pretty good. Some sectors are going to come out stronger than others in our view. Industrial and logistics, convenience, retail, we think we're there. And we expect the next phase to be a gradual improvement. And as rates come off, and the tenant demand continues, they'll perform well. It's likely office will lag a little bit. But even in the office market, we're seeing pockets of opportunity where the rewards are outsized for the level of risk that you're taking on. So it really is looking at the markets, not assuming that even when I talk office, we're sitting here in the North Sydney office. It's a very different market than where I just came from in the Martin Place. The tenant demand in that core central CBD is far outstripping what we're seeing in North Sydney. So investors and the audience need to do the research, look at the individual vacancy rates, the supply coming on, and figure out where they want to play in that risk-return spectrum.
And that is probably my frame of reference, because ultimately walking around North Sydney and you do see a lot of vacancies, but that's we're in a bubble, and that's not necessarily reflected across the Australian economy. And I suppose what you're describing is that resiliency of the Australian economy, of the Australian workforce, because you mentioned that tenant default is really low, but we're also seeing that in the residential market as well. And this is how I kind of try and understand commercial property, just drawing the base analogies, which is mortgagee defaults are remarkably low in Australia as well, which is showing
what
the
a
resilience.
surprise!
And
no one thought that.
It's absolutely a surprise. And I mean, we only have to turn the clock back, 12 months, as you mentioned, 24 months, and people projected that interest rate rises would lead to this doom and gloom. But we have a resilient workforce here. Now, I'm interested, and tell me if I'm digging too much, but there are clusters. Some Australian cities are more in boom than others. Some types of commercial real estate would be more in boom than others. Where are a majority of Charter Hall's assets in this space?
Look, we are sector agnostic in the core space. We do recognise that investors may be overweight a particular sector, but Liam, you're right. There are particular areas where we see greater growth in the short to medium term, particularly. You take the office market. Brisbane, CBD for prime assets has a vacancy rate around 8.4%. Very low. Canberra, 7.4%. Much lower than what you're observing in some of the other markets like Victoria. And even in the Melbourne CBD, if you look at the Paris end, we like that a lot. It's where the top tier tenants want to be. The amenities terrific. Then if you look at, say, Deep Docklands, there's parts and streets around there where you can walk around at lunchtime and it feels very vacant, lacking vibrancy. and it's struggling to attract the tenants back and the people back into that market. So even within the Melbourne office market, it is very segregated in terms of where we're seeing the tenant demand. We do believe the industrial and logistics market, the vacancy rate's around 1.9% nationally. It's the lowest in the developed world. And people were expecting the supply response to be much greater, considering we've had multiple years now of rental growth across the country of 15% plus in industrial and logistics. And yet we're still sitting at a vacancy rate of 1.9%, well below the equilibrium level. So the reason for that, and something that probably isn't as well understood in the commercial space, I think it's very well understood, particularly with recent media around the residential space, that supply isn't keeping up with demand. So the higher interest rates has led to higher financing costs. You've got a shortage of trades. Construction materials have gone up. Land values have increased. And what it's meant is that the cost to build a new asset, whether it's an industrial warehouse, an office tower, is typically 20 to 35% above what you can buy an established asset. So just think of a rational investor. We've got development teams. Why would you build an asset with significant risk if you can buy an equivalent for 20 to 30% less? So we firmly believe that the supply response is going to be much more muted and lagged. And if you're talking commercial office towers, these things take 6 to 8 years if you're trying to build in a CBD like Sydney to get out of the ground. So anything that's not shovel ready and underway now won't be built till after 2030. So as an existing landlord, and we've got $80 billion of assets across all the sectors, and we also have some other investments. But we think for those owners that have high quality, strong real estate, that these will be what continues to be in demand. They're below replacement cost. And ultimately what that will lead to is higher rental growth rates. And whether you're talking equities, whether it's an unlisted company, ultimately what drives value is higher levels of income. So that's what we're focused on at Charter Hall.
The 2030 figure's quite sobering, right? Because it is that reflection of risk that if you are potentially looking to invest in something now that's not shovel ready, like you said, you're onboarding so much risk into your own investments, and you're pushing it out into the next decade. It's a great reminder. Now, on the I&L side, that's a remarkably low vacancy rate, like 1.5%.
Yeah, 1.9.
1.9. Is that potentially, and do tell me if I'm maybe inferring too much here, but is that because of the increased demand for land for residential dwellings that now it's just become bid up in what's left over in the I&L market?
That is a good point. You should almost sit on the Property Council Industrial Committee, because that is something that they are looking at. A natural competitor for industrial and logistics space, and think about them, they're often quite large land holdings.
Exactly.
Is the continued spread and urbanisation of the residential side. And a city like Sydney, where you're landlocked on all sides with national parks, mountains and the ocean, well, you're in competition. What I would say is one of the things that is holding back supply, particularly in the industrial and logistics space, is the lack of enabling infrastructure. And that's just a fancy way of saying, well, you can have a DA-approved site to build a warehouse, but that's of no value to you if you don't have roads, if you're not connected to the grid, if you can get the power that you need, if you're not connected to the water supply and sewer. So these are particularly large constraints we're observing in parts of Western Sydney and other parts of the markets across the country. And a lot of the trades, the utilities that we need as a real estate sector to build these, you are in competition with some of the big government projects, the infrastructure projects.
Yeah.
Absolutely. And they can pay quite well. They're on long-term contracts, very little risk for those contractors, builders. And that's where you're seeing a lot of the supply of those trades go. So I don't think there is a quick fix. If we look at most of the industrial and logistics that's coming through, most of it's pre-committed by tenants, meaning that it's fully leased before you hit practical completion, so the development of the site.
Now, we've heard a lot about the positives of investing in this area and, well, I mean, some of the challenges that we have, which shows why Charter Hall will be and is so impactful for its investors in this space, because you can do it at scale, right?
Yes,
you can do it at
absolutely.
scale. What are some of the risks for investors in this space, and how can they go about mitigating those?
The first thing I would say is real estate, more than a lot of other asset classes, varies materially by the individual asset, the market, and the sector that you decide to play in. So if you're listening to this and you think, you know what, I like those structural tailwinds, the fundamentals of industrial and logistics, I'm just going to load up. Well, all industrial isn't the same. So I'll give you a specific risk. We've seen the last few years what's been coined the romance of reversion, where because of the very high levels of rental growth, you've seen buyer demand for properties with very short leases, secondary, tertiary even quality, low quality tenants being bid up materially because people are hoping to capture this short-term rental pop. And that's could work well, but it really depends on the entry price and what you pay. So we've been outbid 20, 25% for some of the assets in this space. So you can overpay, in our view, even for an asset class. It's no different to the stock market, whether you're looking at NVIDIA, Tesla. They're good companies, but what are they actually worth and what's your entry point can really drive the returns. In terms of gearing, I'd say as a sector, it's done much better. Like if I think back to earlier in my career, the GFC, the managers approached the GFC with much higher levels of gearing. I look at all our funds now, they're all within the gearing bands, typically around 40%. And that's a good position to be in as you approach the bottom of the cycle. The other risk I just highlight to people is look at who is paying the rent. So this office partnership I was talking about, it's anchored by BHP, Australian government. These are tenants that can go through any cycle.
Absolutely.
And as a landlord, I want tenants that will pay the rent, whether it's through COVID, whether it's through an inflationary period, whether it's through higher interest rates. The ability to pay is something that I value tremendously. And I think you will see as we come out of this cycle and we move into the growth phase, the diversification of the cash flows and the strength of the tenant covenant will once again be rewarded. Whereas in the downturn, you tend to throw the baby out with the bathwater a little bit.
Of course, and having those tenants in that can get you potentially through those hard times are incredibly important for investors, and they will be there for decades.
Yes,
they'll be
absolutely.
there for decades. Now, our listeners on the Smart Property Investment Show, they love their stats. They want to get insights into some of the key statistics. Let's unpack performance drivers for the office sector. Can you touch on things like transaction values? We've already done vacancy rates, also the supply-demand balance. Give us a bit of an oversight into some of those performance drivers.
Yeah, so look, the higher levels of interest rates have clearly reset pricing, particularly in the office market. And what you've seen is you have seen transaction volumes marketably lower than the 10-year average. They're sitting at just under 50% in terms of number. So I think it's about 80 versus 160 being the long-term average. And this is for like asset sales over $20 or $30 million. You are seeing, though, that buy-sell spread begin to close. And we've sold some assets very recently. It's in the papers. We sold a great asset in Martin Place to a German wholesale investor. So interestingly, the institutional capital is beginning to come back into the market, particularly for the larger value asset sizes. The industrial and logistics market, the transaction volumes are rebounding much quicker. As I sit here now, we've had more inbound unsolicited inquiry looking to buy our assets in the funds that we manage at premiums to book value than we've had in the last 2 years.
Yeah, wow.
To the point where as a group, we've made the call that we're not selling industrial and logistics unless there's specific asset reasons where we think the value's been maximised, or unless the premium is sufficient, because we do think, particularly that market will swing very quickly back into where it was 5 years ago, where the large institutions were trying to get set and get their allocation up into the industrial and logistics market. Vacancy rates, also another one I've talked about, industrial and logistics. The vacancy rate for the office market is quite elevated in some of the markets. So on a national level, and we tend to split it. So for assets less than 10 years old, so these are the modern assets, high environmental ratings, the vacancy rate's around 13% for prime CBD. For the whole CBD, it's around 15.5%. So you are seeing tenants voting with their feet in terms of the newer assets.
Now, on the I&L side, so clearly it's booming as an asset. Now, what are the main factors behind this? Is it population? Is it online retail? What's the reasoning for it?
All of the above. So regardless of your listeners' views on the benefits or anti-immigration and the population growth, what I would say as a landlord and for those investors that have money in real estate funds, more people is a positive. So every new person that comes to the country, our estimate is you need 3 to 4 square metres of industrial and logistics space.
Wow.
You look at the office market, you think of who are the immigration that we've been targeting historically. It's typically educated, white-collar employment. Okay, well, where do they tend to need to work? From office. So you are seeing a lot of these population trends, and there are some negative consequences clearly with what we've heard with residential and different views on that. But it is something that's continuing to drive tenant demand and net absorption, which is just a industry speak for net tenant demand.
Now that is a really interesting point, and I have not considered that because with population growth, I boiled it down to definitely an oversimplistic thought, which is, well, you'll need half a dwelling per person or a third of a dwelling per person, but it's a sum. So you need the extra I&L space, you need the extra office space. So what might be an individual coming through actually right across the property sector needs multiple elements of it.
Absolutely, even convenience retail. So people need to go to Woolworths, Coles, your Audis, buying food. So we estimate over the medium term you need 600,000 square metres of new neighbourhood shopping centres. They're very challenging to build. So where's the logical place you want them? Near population hubs. What's the highest and best use? Well, it's often residential. So trying to get sites, build them. You heard what I said around construction costs and them being much higher than existing assets.
Absolutely, yeah.
And our forward-looking supply pipeline is not at 600,000 square metres. So these are all good trends. And I want to stress to the audience, property is a long-term investment, right? So I don't want people to rush out and go, okay, I'm going to miss it. We are still coming off the back of a tough period in the real estate market after the last 2 years when vals peaked in June 22. But these structural benefits that will impact all sectors, whether it's population growth, some specific ones, e-commerce and industrial and logistics, tenants focusing on high-quality office and the bifurcation of that market, these are trends that will play out over the medium to long term.
Now, looking at the retail property market, you've already touched on it a little bit, but a lot of people listening to this show might see there are some long-term behaviours being embedded in consumers driven by hybrid work, remote work, online shopping. Do you foresee that those are going to be long-term? What impact do you think the changing behaviour of consumers is going to have in the retail market?
Yeah, look, obviously you can now order your groceries online through Coles and Woolworths, whether a lot of people do or not. For a long time, the big supermarkets were almost using online as a bit of a loss leader and trying to, as they got their back of house, their logistics, their warehousing, their transportation set up. We think there's going to be a place for convenience retail, regardless. And heaven forbid, if in 20, 30 years there isn't, you look at where they're located. They're underpinned by very high levels of land value. They're in locations that you can't replace.
The average square footage of your local Woolworths is massive, right?
Yeah, and you think, why have they been built there? Well, it's built there because they're in population catchments. They're well located, typically easy to get to, main roads, access is great. There is something in that where those locations, and we all know that, Maxim, location. We love assets that are underpinned by high relative land value components. So these neighbourhood convenience centres, we think there's a long way to go where they're going to continue to provide steady and growing returns. On the discretionary malls, so I said before that not all sectors are the same, we're probably a little bit more look, it's not a sector that we play heavily in. We'd prefer to focus on resilient cash flows that go through cycles, and those discretionary malls have done an excellent job in repositioning to provide your cinemas, your food and entertainment offerings, but they are still heavily underpinned by a lot of discretionary retailers. So it doesn't mean that they won't do as well, but we've tended to focus on that convenience part of the retail market. And the other thing I would say is just short-term trends. You can't extrapolate them. We already know that the trend towards working from home, a lot of CEOs are beginning to push back quite hard. I'm not going to have a value judgment whether that's right or wrong, but what I would say is that they are seeing that productivity isn't where it needs to be, and they're taking advantage of the softer employment markets to push people back into the office more often because they want that collaboration, they want that community, that cultural aspect. And we just saw Amazon mandate 5 days a week. And you look at the level of patents that they've been getting approved. It's dropped materially in the last few years. They've gone from 3 days to 5. You saw Tabcorp come out and mandate 5. You saw the New South Wales government now say the majority of the time back in. So I wouldn't say flexibility is going to go away, and I hope it doesn't, because I think it is good for people to have that flexibility. But I think the trend back into the office is gathering speed based on the large tenant customers and government entities that we're talking to.
Now, I can be far less polished with that answer. I think, I think it was transitory. I thought it was momentary. Well, it was a recent stat that came out this week, which was 3 in 5 CEOs think it is not going to be around forever. The hybrid work environment will be around forever. And let's just cast our minds back, because up in Sydney, we had the 2 lockdowns. After our first lockdown and we started coming back into the office, it was almost like, okay, cool, the doors are open, you come back in minimum 3 days a week.
Yep.
And it was the second lockdown that made people very hesitant. People were very hesitant. I think the expectation after the first lockdown was we're going to be going back to 5 days a week. Maybe not now, maybe not next month, but probably the month after or the month after that. People got a little bit shakier after that, and it was, maybe a day, maybe 2 days, maybe 3 days. I think it is momentary because there is, in my opinion, a level of collaboration that you can't get remotely. However, now, I like the point about the square footage of your convenience retail in population centres, because it does make a lot of sense to me that it can also be used as like a pseudo warehouse.
Absolutely.
Now, I'm very big in doing click and collect or ordering my groceries online. Not because I'm lazy. I want to
would ever suggest that, Liam.
But because you can shop by specials.
Absolutely.
So you can go online.
At a time that suits you.
At a time that suits me. So I can go online and I can literally just select everything that's on special, basically then saving $30, $40 on your shop. And then if the delivery costs you $5, well, then you're $25 up. But that is collected from the local store. So it's not only operating as a storefront, giving it advertising, the advertising benefits, the walk-in benefits, but also it's being used as a distribution hub for people in the population centres that are buying online. So it's got that kind of 3-part use for retail. So I think your points there are incredibly astute. Now, looking at Charter Hall more broadly, how do you navigate such dynamic market conditions? I mean, it's always going up and down. Even just today, we covered so many different areas of the commercial property market. How do you guys navigate this?
Look, I think we've got 2 major benefits. If you look at Charter Hall, actually 3, I'll chuck in an extra one. We've got 1,600 assets across the wider group. That gives us unparalleled data in terms of what our tenants are experiencing, what's happening on valuations, what's happening on construction costs, what's happening with our suppliers. We get the scale benefits as well. So we negotiate electricity contracts across the portfolio. The second thing I would say is because we are in all the core real estate sectors, so office, industrial and logistics, retail, we have multiple touch points into some of the largest corporate and government entities in the country. So I'll give you an example. Coles, we have them in so many neighbourhood shopping centres, I've lost count. We have their head office down in Toorak in Melbourne, so the office property. And we have a lot of their big industrial and logistics warehouses. It means we're constantly talking to whether it's the head of the property team, CFO, CEO, and we understand our tenant customers, I think, better than just about anyone in the industry. The other thing I would say is we've stuck to what we're good at. Real estate is a very local game. We've got 600 property professionals across the Charter Hall business, and they're located where we own the assets. So yes, whilst our head office may be Sydney, we've got 50 or so people up in Brisbane, same again in Melbourne, a team in Perth and Adelaide, because you do need to be experts in the dynamics of what's happening in the individual local markets.
There's nuances, there's subtleties in each local
and
market.
Relationships. So real estate is a relationship game. So building those tenant relationships with the leasing agents, sales agents, your suppliers, your contractors as well.
No, that's fantastic. Look, I think that is all we have time for today. Thank you so much for joining us on the podcast.
Fantastic. Thanks, Liam. Pleasure to be here.
That was Steve Bennett, CEO of the direct property business within Charter Hall. But that is all we have time for today, and we'll be back very shortly with another Smart Property Investment Show. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.